some of the slides that I had put up before the session, showing some spring scenes here that we hope to see in Edmonton, downtown Edmonton area sometime soon. So yeah, that just gives me some hope that spring is just around the corner. I was in a webinar yesterday that said yesterday, February 27th, was National Polar Day and something like National Pokemon Day. So apparently today, February 28th, is National Chocolate Souffle Day, as well as National Pancake Day. And of course, it is Pink Shirt Day as well. So I hope you don't get chocolate and maple syrup all over your pink shirts today. Again, please be aware this session is being recorded and will likely be posted online. My name is Angela Bilski. I'm a municipal advisor at Municipal Affairs. Been here for almost 8 years now. And with me, I have Jordan Velastin. He's a financial advisor. We have Kauser Kanduker. He's another financial advisor. And of course, we have Lucien Cloutier, another governance advisor that will be moderating our chat and probably putting in some funny little comments in the chat as we go, which he's known to do and which we appreciate. Again, I've put the session material link in the chat. If anyone doesn't have access to that right now, you can just click the link and it should show up for you if you want to follow along. All right, so generating revenue to fund municipal operations is obviously hugely critical for municipal sustainability. And a large part of your revenue in municipalities comes from taxation. So there's several different types of taxes under the MGA that allow municipalities to impose, including business tax, local improvement tax, special tax, and a few other ones. But today we're going to focus on usually the most significant source of municipal revenue, which is our favorite, property tax. And property tax can't legally be imposed without creating a property tax bylaw first. So we thought this would be a good time for a session dedicated to creating this important bylaw. And if you do have questions as we go, please put them in the chat and Lucien may be able to answer them on the fly, or we will address them at the very end. So this is an outline of what our session will look like. Our primary goal is to give you a good understanding of the legislative requirements involved in the tax rate bylaw and highlight some important considerations you need to keep in mind when developing your bylaw and sending out those tax notices. And to give you some practice with plugging numbers into the bylaw, Jordan will be working through the case study that was sent out last week. And I'm hoping many of you reviewed the case study in advance. And for those of you that did, you get a gold star. And for those of you that didn't, I'm not sure what the opposite of gold star is, but in any event, the material will be available if you want to go work through it afterward as well. Jordan will be talking a bit about how your tax rate numbers get reported to our ministry through the financial information return, as I believe there have been some changes to that area recently. And again, whatever time we have left will be dedicated to fielding some of the questions you might have. So again, please feel free to pop those in the chat as we go. So to start off our discussion about the tax rate bylaw, let's take a very high level look at how the property tax process flows. So the annual budget is an absolutely critical first step that determines which infrastructure and services will be provided to residents and at what levels, which ultimately determines the tax rates necessary to fund them. So those operating and capital budgets were required to be passed before January 1st of the current year, but often an interim budget is done at that time with the final budget approved by council early in the year after they've gotten more information about assessment numbers and provincial grant funding. So once council determines the amount of money needed to operate the municipality for the upcoming year, known revenues such as permits, licenses, users' fees, and grants are subtracted, and the remainder is the amount of money the municipality needs to raise through property taxes. This revenue requirement and the property assessment amounts are then used to calculate tax rates. And the annual tax rate bylaw required under Section 353 gives the municipality the authority it needs to impose and then to collect property taxes. And it's important to keep in mind that the terms assessment and taxation are related, but they aren't interchangeable. Assessment is the process of estimating a dollar value on a property for taxation purposes, whereas taxation is the process of applying a tax rate to a property's assessed value to determine the taxes payable by the owner of the property. So let's take a closer look at how tax rates are calculated. The tax rate is the percentage of assessed value at which each property is taxed. Section 355 sets out that the revenue requirement determined by the budget is divided by the assessment base, which is the total value of all assessed properties in the municipality. So you can see by this formula, budget requirement divided by assessment will give you your tax rate. So using nice round numbers in a municipality that charges the same tax rate to all of its assessment classes, so just to make it super simple, this municipality has determined that $1 million is required to cover the operating and capital costs minus other revenue sources such as grants and user fees. If its total assessment base is $100 million, they need to apply a tax rate of 0.010. And then we always get the people that are more familiar with the term mill rate, which is how it used to be referred to in old legislation. The mill rate is calculated by simply multiplying the tax rate by 1,000. And that makes it much simpler when you're communicating with people about how much taxes are being applied. So in this example, the mill rate would be 10. However, you won't find the term mill rate in the most current version of our MGA. Again, before the tax rates can be calculated and applied, council has to approve the operating and capital budgets required for the upcoming year. Your municipality may have passed an interim budget before the end of last year, but will pass the final budget in the early part of this year. So looking at this formula, which is the only part of the equation that council has control over? So they can't change the assessment value determined by the assessor, and the tax rate is simply the budget requirement divided by the assessment. So the only portion council can control is the budgetary revenue requirement. So it's important for administration to ensure council is aware of the effects of the proposed budget on tax rates when the budget is being deliberated. This is the appropriate time for discussion on how the revenue requirements will determine the resulting tax rates, not the day you are hoping council passes that tax rate bylaw. The preparation time leading up to the passage of the final budget is when you are going to want to present example assessment rolls, tax rates, and resulting tax bills to your council to reduce that sticker shock that they sometimes get when they are passing the tax rate bylaw. There should be limited discussion when it comes time to pass the tax rate bylaw, as the bylaw is simply the resulting calculations using the revenue requirements already approved at the time and the assessment numbers provided by your assessor. If council decides the tax rate resulting from the approved budget would be unacceptable, then the budget must be revised to reduce the expenditures so that the revenue requirements are lowered enough to produce a tax rate council can actually live with. If council wants to reduce the budget, which sometimes they do, they must specify what programs or services will be reduced and not simply ask administration to cut a certain dollar amount or percentage, as council is the body responsible for setting the budget, not the administration. So the only policy decision left at this point is how the burden of the budget requirement will be distributed among all property owners. But before we talk about that, let's look at assessment classes and subclasses. All right, so currently the MGA includes 4 broadcast classes of property assessment, with 2 of them allowing for further subclassing. These are important because the assessment class or subclass determines the tax rate that will be applied to each property, as they can have different tax rates under Section 354. So starting at Class 1, which is residential properties, this class can be subclassed by bylaw to any extent that council considers appropriate. And that is allowed for in Section 297 sub 2. So some common examples are vacant slash improved and multifamily slash single family. Rural municipalities may have subclasses for country residential and hamlets as well. However, the municipality should be prepared to explain and justify any differences in tax rates for residential subclasses. So they might believe that there's a different service level, for example, in a certain type of property that could warrant a difference in tax rate. Then we have Class 2, the non-residential class, and that is made up of linear and commercial type properties and includes a subcategory called designated industrial property. And that involves things like large refineries, wells, pipelines, power systems, and other related property, which are assessed by the province. You can see non-residential can now be subclassed into 3 different subclasses. So vacant, small business, and other non-residential. There's a regulation that sets out these provisions, and it's called the Matters Relating to Assessment Subclasses, or MRAS for short. And that regulation further defines the requirements around properties qualifying for the subclasses. And this regulation, there were some changes through Bill 21 that was passed a few years ago. So the regulation is still in place, but eventually you'll find those provisions right in the MGA in Section 297. Not sure when that's happening, but that's supposed to happen eventually, I guess. Then we have Class 3 farmland, and Class 4 is machinery and equipment, or M&E for short. And currently, these last 2 cannot be subclassed any further. So additionally, one or more classes or subclasses may be assigned to a specific property. So for example, you could have a commercial building that has a residential component as living quarters, for example. Before an assessor can apply subclasses to the residential and non-residential classes, council must pass a bylaw. So since the assessment rule must be prepared by February 28th, which is today, this bylaw should be passed well before that. And if the subclasses needed to be changed for this taxation year, that bylaw should have already been approved by council. And if not, it will have to wait for the next taxation year. All right, so hopefully everyone's doing okay so far. Just wanted to include a recent example of a subclassing decision that someone thought was newsworthy. This happened, I believe, last week. So look, this council passed a bylaw that created tax subclasses for both vacant commercial and vacant residential properties. So the reason they did that, so this passing this type of bylaw allows them to set a higher tax rate for vacant properties compared to the non-vacant ones, which may motivate those owners to develop their vacant land. And then the city benefits from increased jobs, services, and higher tax base that could be provided when more development happens. So to reiterate, the MGA allows for different tax rates for different classes and subclasses. However, there are a few limitations to be aware of in other sections. So just a few of these I want to highlight. So Section 358.1 requires a maximum ratio of 5:1 between non-residential and residential tax rates. So in other words, the highest non-residential tax rate cannot be more than 5 times greater than the lowest residential tax rate. And another limitation to mention is found in the subclassing regulation. non-residential subclass, the rate for that, the rate for the small business subclass must not be less than 75% of the other non-residential subclass, and the small business rate must not be greater than the non-residential rate. And I'll summarize these provisions in a minute here. So section 357 allows for a minimum tax payable as property tax. And a minimum tax can only be applied to municipal property tax and not to provincial education property taxes or any other property tax. If a municipality wants to ensure that each tax bill covers off the minimum cost involved with each property, such as costs for processing and mailing the tax and assessment notices, for example, it could set a minimum tax payable. However, it's important to remember that a minimum tax must apply to all assessment classes and subclasses. So you can't have a different minimum for each. The additional revenue gained when a minimum tax is applied should be reflected in your budget. And Jordan will be discussing this further when he gets to the case study. And then we have 357.1, which says that residential tax rates must be set above zero. And why would that be? Because of the maximum tax ratio. So when you divide something by zero, you get an undefined number. So that would not fit into a ratio situation. I think I learned about that zero thing through a young Sheldon episode recently. All right, so like I said, here's a bonus slide that gives a visual summary of the assessment classes and subclasses and those rate restrictions that I had just mentioned. So those are found in the MGA and the matters relating to assessment subclasses regulation. And the one item I haven't mentioned is that the tax rate for M&E must be equal to the tax rate for class 2, which is your non-res. And if you're using subclasses for class 2, then M&E must be equal to the other non-residential subclass. And there's a full page handout of this slide in the Google Drive link that I had provided a few minutes ago in the comments. Maybe Lucian could put up that link again if he doesn't mind. All right, thanks. Okay, so let's talk a bit about requisitions. So a requisition is permitted on the tax rate bylaw only if there's a legislative provision authorizing it. So these requisitions on the slide are the only 3 requisitions recognized in section 326 of the MGA. So the first one is the ASFF, or the Alberta School Foundation Fund. And education property taxes are pooled in the Alberta in ASFF and combined with the Government of Alberta's other general revenues to fund the cost of K-12 education programs across Alberta. And this funding is distributed to public school boards and separate school boards on an equal per student funding formula. Then there's the seniors housing requisition, and that requisition funds the services managed by a regional seniors housing authority. So you may or may not have that type of authority in your municipality. And then the third one is our designated industrial property requisition, or the DIP requisition. And that rate is set annually by our ministry. And that's used for covering the province's costs for administering the DIP program, for doing all the assessment of those properties. So that rate will be the same for all DIP properties province-wide. And if you haven't noticed, a policing requisition is not on this slide because there is no legislative mechanism that it be treated that way. So it has to be part of your municipal taxes. And I know councils, not all councils like that, but that is how the legislation is set up. If council wants taxpayers to know how much of their tax bill is going toward the cost of policing, how could that be achieved? So what our usual messaging is that a municipality could create an informational brochure that is sent out with the tax notices, or you could have it posted on your website that shows a breakdown of how much of each tax dollar goes where. So every year, your municipality will receive lovely letters that notify how much has to be contributed to these provincial and regional authorities. Each municipality's share of these costs is calculated using equalized assessment, which is a bit different than the assessment amounts determined by the local assessor. With respect to requisitions under 359 sub 2, municipalities have the ability to establish a rate to recover what they believe will be uncollectible. So this is to help the municipality meet their requirements to pay the full amount of the requisitions that they get notified about, even when they don't necessarily collect all of it from taxpayers. And the rate for this allowance cannot be greater than the actual rate of non-collection in the previous year. Also, this is more of an audit function, but each year your auditor will identify if you have an over/under levy with respect to any of the requisitions, and then provide the appropriate increase or decrease that will have to be adjusted for on next year's bylaw. So that might happen because of Section 305 assessment changes that the assessor makes to individual assessments throughout the year. There's no requirement to show this amount on the bylaw, so it could be included as a budget item instead.
Angela, could you take the question real quickly?
Okay, let me just scroll up here. I can. Okay, so for class 4-8, we have always had a nil tax rate for M&E, but not for class 2. Are you saying that it isn't allowed? Okay, I will look more into that one after Jordan goes through the case study, and hopefully have an answer for that a little bit later. But thanks for raising that. All right, so moving on. We've asked our friends in the MAP area, MAP standing for Municipal Accountability Program, for their list of the most common errors that they find with tax rate bylaws when they go out and about and review municipalities for legislative compliance. So the next two slides are based on their list, and they show some important questions that need to be asked before the tax rate bylaw is passed and the tax notices are printed. Some of these seem quite basic, but yes, they commonly happen out there in the field. And no, I did not dream them up. There's a handout of these slides at the link for the Google Drive. All right, so first of all, has the final budget been approved by council? As I had discussed earlier, the expected revenue and expenditure numbers set out in the approved budget must be used to determine the tax rates that need to be applied to the municipal assessment. There could be some risk of the tax rate bylaw being challenged if it was passed before the budget was approved. And speaking of assessment, it's important to make sure that assessment numbers balance before the tax bylaw is passed. So what I mean by this is that on the day the tax rate bylaw is passed, your assessment file must balance to the assessor's file, both of which must match what the bylaw shows for assessment values. So again, the assessor may have made some 305 changes after providing the assessment roll to the municipality in January or February. So you must ensure that those assessment totals in the bylaw also reflect those changes. The next one, are all the calculations on the tax bylaw correct? So sometimes if you've used spreadsheets a lot, you can see that sometimes the numbers don't get transferred over to the bylaw properly, or maybe there was an error in a formula that went undetected. So we recommend getting a second or even a third set of eyes to check your calculations on the final bylaw with a good old-fashioned calculator. It's actually surprising how many bylaws we see that have major errors with math. Just a reiteration of making sure you don't have any requisitions in your bylaw other than the 3 I talked about a few minutes ago. We've seen municipalities include requisitions for things like fire protection and recreational services, which is not legislatively compliant. Instead, these costs need to be included in the municipal budget, or they could be imposed using a special tax, perhaps. And you also want to make sure the amount your auditor has identified as an over or under levy regarding your requisitions has been carried into your current year from the previous year. This may sound a bit more than a bit obvious, but especially when you use the previous year's tax rate bylaw to create the current one, it's easy to overlook the dates while focusing on the numbers. So you want to make sure those get updated properly as well. As I mentioned earlier, only one minimum tax is allowed to be applied to all the assessment classes. You can't have different ones, or you can't have a 0 minimum tax for some assessment classes. They have to be all the same. A common issue we often see is the current year's bylaw rescinding the previous year's bylaw, which you do not want to do. Coming into a new tax year does not mean the previous year's taxes were never imposed, so you still need the previous year's bylaws to authorize the ongoing collection of those taxes through tax recovery. Not everyone's going to pay their taxes in that year. And when you're developing the tax rate bylaw, it's a good time to review the tax penalty bylaw as well to make sure what is going to be printed on the tax notices is consistent with both bylaws. So back in the COVID days, some councils had put some penalty forgiveness that they maybe had passed a temporary bylaw with a sunset clause, and maybe that bylaw has now expired. So you might want to check if that was the case, if there's anything you need to do to reverse those temporary measures that were put in because of COVID. Another question to answer is, excuse me, is whether your penalty bylaw is explicit in that penalties are calculated on penalties, because taxpayers often question that, even though the MGA states that penalties become part of the tax. Speaking of tax notices, hopefully you'll be taking some time to do some test printing to ensure those pesky software updates haven't messed anything up since the last time they were printed. So you'll want to test print a good sample of notices, including notices Sorry about that. My voice is kind of going. So you'll want to test print a good sample of notices, including notices with every assessment class and ones that have multiple owners and or multiple classes, to make sure the spacing is still correct, all the necessary fields show up, and the calculations still work properly. I only have one more slide, so please bear with me. And finally, you want to make sure your tax rates are within the 5-to-1 ratio, and also that they meet the other restrictions set out in the MRAS regulation I mentioned earlier. So those are the most common issues we see with tax rate bylaws. If you've experienced some type of issue that went undetected for you and caused you a bunch of grief after your bylaw was passed and the notice is sent out, feel free to pop that in the chat so everyone can see or can avoid what you've experienced. All right, this is my one last slide. So hopefully the checklist helps you with spotting any errors before your bylaw is passed and the tax notices get mailed out. But sometimes that happens. So what is the process if it does? If a significant error or omission relating to the tax rates is discovered after the bylaw is passed and the notices have gone out, Section 354 of the MGA requires the bylaw be amended. Amended tax notices be sent out and the ministry be provided with a copy of the amended bylaw within 30 days. So not a process you'd want to go through if at all possible. And it's good. So it's a good practice to spend some extra time double and triple checking everything on the front end to avoid the time, energy, and cost involved in fixing any errors after the fact. Not to mention the awkwardness of having to take the bylaw back to council for a redo. All right. So that is the end of my part.
Before you go on, can we just sort of related to the last thing, but not quite? Amber has a question about over-unders. Is an over-under required for differences in municipal tax rates?
I believe that applies to requisitions.
So is that like over levies and under levies for requisitions? Is that what we're talking about?
Yeah. Yeah, because of this, the 305 assessment changes, right? Actually, let's think about that while Jordan goes through the case study.
Yeah, actually on the tax rate bylaws, the over levy and the under levy are located in the areas of requisition. But yes, we'll go through that. So let me share my screen here. Hopefully I shared the right one. You can see the Excel spreadsheet, right? Yes, Excel spreadsheet.
Yes, we can see it.
Okay, thank you. Okay. Sorry, the heading. Oh, there we go. Perfect. Okay, so welcome. Here's the case study. But before we get into the case study, I know it's been a long sit so far, so we'll just take a quick 2 minutes here and go through some just some light humor on the subject. So for the first one, why was the seafood restaurant being investigated by the CRA? Because they were suspected of being a shell company in some fishy business. I like that one. What is the definition of a good tax accountant? Someone who has a loophole name after him or them. And the last one here. Why doesn't the CRA audit cows? Because the farmer milked them dry. So now we will continue. Okay, so with the case study here, Willie will start from the top. First of all, if anyone by chance doesn't have it, I'll show you where it's located. You just open up a Google tab, you search Alberta Municipal Finance Overview. You can click on the first link. When you click on the first link here, it takes you to a Municipal Affairs website and tax rate bylaw. recorded webinar and case study is right here, and the attachments that I will be going through are right here for you guys if you like. So that's where they are. So continuing on here. So the case study, this is a new Sampleford case study. Just contains fictitious information, but as close as we could get to a general tax rate bylaw. So to start here, we have the operating budget summary. These revenue figures are pretty much or very closely exact to what you would see on a set of financial statements. We are going to be calculating this number. So we have the total revenue here, 855,000, excluding this number. So, and yeah, as mentioned, all of these are basically from the financial statements. Same with the expenses here. All these expenses are typical expenses from financial statements. We have total expenses of 2,526,000. And notice amortization and non-cash expenses 400,000. So again, this is operating. We take the revenue minus expenses. We get the difference, revenue minus expenses here. And then we're going to add back the non-cash items of amortization. We're going to get 1,271. Going to the second page here. Now this is a capital budget, whereas above was operating, this is capital. So we know for operating, we have to collect 1,271. For capital, we're going to find out right now. So we have the revenue for the capital, usually the government transfers and reserves. We have total revenue of 700,000. Then we have our expenses, total expenses, road construction, water treatment, public works equipment, total expenses 850,000. So capital revenue requirements for revenues minus expenses, the difference 150,000. Then also for we also have additional requirements. We have some cash requirements required to pay some debt principal repayment 100,000 and capital reserve 75. So that's a total 175. So we'll stop there. So on this screen, we know we have 150, 175. So now we're going to fill out the top portion of our tax rate bylaw. And I'm going to work with, there's two of them. There's a blank one without any tips, and there's one with tips. And I'm going to go through the tips. So this is basically a good regurgitation of everything Angela mentioned in her portion of the presentation. But you can see how it actually applies to a tax rate bylaw here.
Can I interrupt you for just a moment?
Sure,
Jordan?
sure,
There was a
yes.
question about why you added back non-cash items in that.
Sure. The reason why you had back non-cash items is because depreciation expense really is not an expense that that you actually paid for or went out when you like for example, I'll go back here to the previous expenses here. These expenses you actually have to pay for, like administration, legislative costs, bylaw enforcements, wastewater, like municipalities and businesses and any entity pays for these. Amortization, it's more like a depreciation on assets, so you really don't pay for it. It's kind of behind the scenes. So when you are calculating a cash flow and you want an accurate cash flow, there's no outgoing cash flow for depreciation amortization. So in reality, you have to add it back to incorporate that. Yeah, hopefully that answers that question. And we'll be going through that further as well regarding our tip number 2 as well. So going back to the tax rate bylaw, you can see, whereas County of New Sembleford has prepared and adopted detailed estimates of municipal revenue, expenses, and expenditures as required at the council meeting held on December 31st, 2x4. So, tip number 1, council must adopt an operating and a capital budget or an annual budget by January 1st of each calendar year. So that's section 242, 245, and 248.1. So remember from the case study, we know that the estimated revenues from all sources other than property taxation was 855,000. Oh, and before I start here, I just wanted to show you that this worksheet is completely empty. So we are going to be filling it out as we go, and it will kind of fill out for ourselves for ourselves. And it is a basic tax rate bylaw. Yeah. So 855,000, we knew what that was. The estimated municipal expenses set out in the budget, including non-cash items, so excluding depreciation. That was that 2126. And that will get our amount here. So this 1271, as we mentioned, this is a number that we need to collect for our operating. Now we are going to find out how much we need to collect for the capital, and then we're going to add those up, and it's going to equal this number here. So the estimated amount required to repay debt principal, we knew what that was. That was the 100,000. If I remember correctly, yeah, 100,000. Capital reserves was 75, and the difference was 150. So we're going to enter those. And just so you see this more clearly, we can make this more clearly as well if you want. This was just the 2526 minus the 400,000 is the same. There we go. Okay, just so it's clearly. Okay, so principal payment was 100. We know that the current year capital expenditures and the capital transfers was in the reserves. This one was 150. And this one was 75. And we know that the amount we need to collect is here, and I have a little check here. Or let's just see, yeah. Check here. This is a very quick overview of what we just entered. So the capital operating revenue was the total revenue, the 2126. We have to collect this number, but for the total expenses here, the depreciation we had back. And when you do all of this, it actually evens out. It gets a 0, and that's how we know we have to collect the 1271 for operating. For the capital budget was again the 700 minus the 850. We need to collect the 150. We have the debt principal repayments. The capital reserves outflow was 175. We add up both of those, we get 325. We add up both of these, the operating requirement, the capital requirement, we get our total requirement, 1596. So that's how we get the 1596. Just a little brief overview. We'll go back to the case study now.
Jordan, while
Yeah.
you're doing that,
Yeah, sure.
there's a question. Does
Sure.
this have to be the format of the bylaw? Does it have to have all the budgeted numbers broken out like this and listed in the bylaw?
We read a lot of bylaws, and they're all kind of like this. They're all kind of different in their own way, but this is how most of them look like. Whether you have to or not, I'm actually not quite sure. But I know if you would like to see other tax rate bylaws other municipalities do, they're all listed. They're all online. And they all look very similar to this.
I don't believe there's any any kind of legislation or regulation that sets out the format the tax bylaw has to follow. But I
Yeah.
think the one we use is kind of the best practice type of one that has the most information possible for your
Yeah.
taxpayers.
Yeah, Angela and Jordan, you are right. As Jordan mentioned, so when we saw that the tax rate bylaw, there is a calculation is not match. So it is the simplest way. And sometimes maybe council are asking, how do you get these balances there? So easiest way you can explain to them. So you can use your way, but this is the simplest way to get it. The balance is there, then and easy for you to make your tax collection and then tax rate and other stuff is there. But as I mentioned, Jordan, there is just so many bylaws you can find online. So you can follow some of them, so which is easiest for you. Thank you.
Okay, so thank you very much. Yeah, we're going to continue here. So we'll go back to where we left off now. So requisitions. Alberta School Foundation Fund, residential farmland. There is an under levy on this one, non-residential, Seniors Foundation, designated industrial property. So we're going to enter these requisitions, and we also have some assessment information, residential subclass, as Angela was mentioning, farmland, non-residential. There's a non-residential small business also, as Angela was mentioning, machinery, equipment, and designated industrial property. So now we're going to get that. So those are the assessments. We're going to enter those. So, but before we enter those, we'll go through a few of these. So yeah, as kind of mentioned earlier, total municipal taxes required, expenses minus revenue, plus debt repayments, plus capital expense, plus future capital savings. And then if you wanted to actually, you would add back the depreciation as well. So municipality may choose to show the under or over levy in the requisition section of the tax rate bylaw as a separate item, or to include it as part of a main requisition. So we have it here as a separate item. There's allowance for uncollectible taxes. Municipality may include an allowance for non-collectible taxes. That's section 52.9. In this case, later on in the case study, it is 0, so we're going to leave that as 0, but we are going to fill that in. And also, so for the requisitions, Alberta School Foundation is provided by Alberta Education. Designated industrial property is provided by Municipal Affairs. And Seniors Foundation is provided by the related Seniors Housing Foundation. So we know that for requisitions and farmland, requisitions, residential and farmland, this is 210,500. So we're going to enter that in. 500. There is there is an under levy of $10,000 and non-residential of 94,500. Go. Okay, and the designated industrial property was 745. And I'll show you how we get that in a minute. Seniors Foundation was 21. Okay. Now we're going to enter, the assessment information. Whereas the assessed value of all property found in New Sampleford as shown on the assessment roll. So assessed information, we have all the classes we just mentioned from the case study, so we're going to enter those. We have, this is residential and farmland. So we know that residential is 90. Farmland 6.1. There we go. Residential subclass was 5 million. Non-residential was 15 million. Non-residential small business, 5 million. Designated industrial property, 9721. And machinery and equipment, 450. And there we go. So a municipality may by bylaw establish a small business subclass for non-residential. As Angela mentioned, this is in the matters relating to assessment subclass regulation. And designated industrial property is not a major assessment class. So have you, look if anyone noticed that. But is included in the non-residential and or machinery and equipment assessment classes. So here in this example, DIP is shown above is as a requisition for calculation purposes. However, DIP is included below as part as a non-residential assessment. So just letting you be aware of that. Now we are going to go to yeah.
Jordan,
yeah,
before you
sure,
do that,
sure,
we're starting to get
sure,
some questions to pile
sure,
up a little
sure,
bit. I wonder if we
sure,
could. So the
sure.
first question is, our comment is that the sample bylaw does not have the check tab in the Excel spreadsheet sample.
Yeah, it doesn't, because I just added that a couple days ago.
Okay.
I just added that a couple days ago. I just did it myself.
Okay.
Yeah, we can add it. We can post this on the website like we did the other Excel spreadsheet not too long ago. We will do that, so don't worry about that.
Next question, do you know if M&E is included in the assessment amount for ASFF?
We've had that question before, and the province has set that rate at 0 for M&E for the ASFF since 1998, I believe. So
So essentially,
province,
no.
right.
Okay. And one last thing, can you clarify allowance for uncollected tax in the school tax session?
Yeah, allowance for uncollected taxes. What example of that would be?
So like I had mentioned earlier, you can create an allowance for the taxes that you don't collect, so that you know, if you owe say 100,000 and you only collect 90,000, you can set that allowance for the difference. So that's where that shows up.
I believe
So it
Does that answer
translates
the
into
question?
a slightly higher levy. So essentially that shortfall is essentially covered through taxation of the parties that are the good law-abiding people that pay their taxes.
Right.
And also auditor end of the year, when auditor do the auditing any short for the school tax collection, they do adjustment for auditor. Their note is their school tax shortage.
If that doesn't answer your question, we can take that offline.
Yeah. No, those are great questions. Okay, I will continue here. So we're going to continue reading the text of bylaw now. We're just going to finish this last portion here. So in 2004, the Council of the Town of Sutherland adopted a policy regarding proportion of the municipal tax revenue requirements to be derived from all assessment classes to provide consistency for administration when preparing a draft tax rate bylaw. Below are excerpts that policy that will help in developing the 2005 tax rate bylaw. So the division of tax revenue collected from residential and non-residential is 70% residential and 30% non-residential. Of this 70% residential, 90% will be residential and 10% will be residential subclass. Of this 30% non-residential, 88% will be collected from non-residential and 12% will be non-residential small business. Municipal tax rates for residential and farmland assessment will be equal. The municipal tax rates for non-residential and machinery and equipment assessment will be equal. An allowance for non-collection of taxes is 0 for the current year. That's why we had a 0 up above. And the minimum municipal tax for taxable properties will be 500. So now we're going to incorporate this information into the tax rate bylaw. So we finished filling out requisitions and assessments. So now, the chief administrative officer is hereby authorized to levy the following rates of taxation on the assessed value of all property as shown in the assessment roll for the town of New St. Paul. So general municipal. So this is residential and farmland. So we know that residential is 70% and 90% residential. So we're going to enter those. So we're going to go. So way up here, when we calculate this number, the 1596, this is the total amount of operating and capital we need to collect. So this number went right here. These are the same allocations that we just spoke about on the case study there. Residential, non-residential, and how those are broken down. Residential breakdown and non-residential breakdown. So going back here. Shoot. This one. Sorry. We're gonna go equals our total amount to be collected times 70% times 0.90%. That's our first amount for residential. Now we do residential subclass. Close this one. So still residential, but now residential subclass. And now we're going to do the non-residential. So this time it's the 30% times the non-residential breakdown, non-residential. And now it's non-residential small business subclass. So we'll go here. So we got a non-residential times the breakdown, non-residential small business subclass. And we know we did it right if this number adds up. So, and it does, it's a 1596. So this equals 100%. So we know we did that correctly. These assessments here filled out as we completed up above. And it's just a simple math calculation. Tax levy that we need for each class divided by the assessment, and those equal the tax rates. So now we have to make sure that these tax rates comply with any other regulations. So Section 297 establishes 4 major assessment classes, as we know: residential, non-residential, farmland, machinery and equipment. And Section 354 authorizes different tax rates for each assessment class. So the highest tax rate for non-residential properties must not be higher than 5 times the lowest tax rate for residential properties, Section 358.1. So we can check that by here. So the lowest residential rate was between these two, it's this one. And the highest non-residential rate between these two is this one. So we just simply divide that by that, and it's only 1.3 times, less than 5, so we're okay. Machinery equipment has a 0% tax rate for the purposes of ASSF, which was the question that we answered earlier. Alberta Regulation 202, matters relating to assessment subclass, section 3. Tax rates also states that small business property subclass may not be less than 75% of other non-residential property. So we're going to make sure that that's still correct as well. So we have our non-residential rate of 0.011 and our non-residential rate of 0.14. So this number divided by this cannot be less than 75%. And as we see, this divided by this equals 80%. So we're okay. So these are a couple things to be aware of when you are calculating your tax rates, just to ensure that just because you've calculated the rates, that these calculations still comply. And as we completed all of those entries, we also completed we also completed the remaining entries for the bottom here. So and this 7,445 was actually a calculation of the tax rate and the assessment. And just know that this, well, I'll read this here and then you understand. So the provincial assessor will provide you with the tax rate to charge for the DIP requisitions if you have DIP properties in your municipalities. Most likely you do, but it's if you have. So we use the 2022 figure. There is a 2023 figure. So in 2022, this figure was 0.0000766. In 2023, it was 746. So we simply take this, and do the math backwards, and that's how we got 745. I mentioned that at the start as well. For 2024, I'm not sure if we have this already. I just don't know that. Maybe we do, maybe we don't. Municipalities are required to set the same local school rates for public ASFF and a separate opted out rate for school board supporters for each class of property as per section 162B of the Education Act. Under ASFF, municipalities may choose to separate line for under and over levies or can include within existing requisition. We mentioned that above as well. The under levy above is included within residential and farmland. And we also know from the case study, as we mentioned, the minimum amount payable per parcel is $500. The MGA allows for one minimum tax rate, section 357, and revenue generated from the minimum tax should be included in the budget as shown on the property tax bylaw. So that is the end of the case study here. Before we get on to the next portion of this presentation, we are going to take another brief 2-minute break. And we're going to answer these two questions. What is the difference between the short form and the long form? Well, the accountant says if you use the short form, the CRA gets all your money. If you use the long form, then I get all your money. The good one. How did Form 1040 get its name? For every $50 you earn, you get $10, and they get $40. What is the difference between death and taxes? Is a good question. Your municipal government does not meet every year to make death worse. They meet every year to make taxes worse, but maybe not death worse. So the good one again. Okay, so just stretch the eyes and we're going to get back into this. So now a different kind of portion of the presentation is reporting for tax rate bylaw values on the financial information return. And this is a bit different from what we've done in the past. So there's been some recent updates. We'd like to highlight those changes to ensure there's minimum surprise in the future. And if you are surprised, you can call us anytime. We're more than happy to help you. So,
Sorry,
yeah,
Jordan, 5 minutes real break. You want to give 5 minutes real break?
no, I don't.
Okay.
Yeah, so this is so the information services team collects the data from the municipality every year, and this is just a brief summary of what the information services team does. So some examples are we collect data on municipal officials, who they are, their contact information. We collect municipal, there's a tab there. You can click on these, and they're all found on Municipal Affairs website. Municipal profiles, overview of the municipality with basic statistics. There's the Municipal Measurement Index, enables users to track progress and compare municipal stats with other municipalities. And there's municipal indicators, serves important metrics and benchmarks that municipalities must satisfy. It also helps track viability. And those are really good. I would expect that most of the audience today has seen the municipal indicators. If you have not, just send us a note. We'd be more than happy to go through and share those with you. But very cool, actually. And much more information as well. But that's a portion of their information. So how do they collect this information? Well, they collect it through various means. This presentation today, we are just going to discuss the tax rate bylaw portion of this. The financial information return is more of the financial statements. Today's just primarily the tax rate bylaw. So for 2024 submission, there's going to be a submission template whereabouts municipalities will submit their tax rate bylaw and template with figures input. Municipalities would have received the email from Municipal Affairs. It was sent out around December 22nd, 2023, and that was for this upcoming 2024 reporting year. The email contained Excel tax rate bylaw template. It also had a PDF with instructions and FAQs, and the ministerial order putting all this into effect. So if you don't want to fill out the template or you're too busy or anything like that, there's a ministerial order. So kind of have to do it, and we're more than happy to go through if you have any questions about that as well. So Municipal Affairs will then review both the tax rate bylaw template and tax rate bylaw together. And the addition of the template, it just has basically the main goal, and that's to reduce errors made on the tax rate bylaw, because it's not common, but it is more common than you would think, and anyone would like that. Municipalities do have 1 or 2 errors on their tax rate bylaw. And that way we just can reduce errors and get a more formalized approach to this as well. So as mentioned, the ministerial order that put all this into effect was Ministerial Order 079/22. It outlines that municipalities must submit their tax rate bylaw to the ministry by July 1st every year. You can see that for 2023, only a signed copy of the tax rate bylaw was from Municipal Affairs. However, for 2024 going forward, a signed copy of that, in addition to the new template, will also be required. So this is just kind of a brief snapshot of the ministerial order there. So as mentioned previously, a new tax rate bylaw submission template has been developed. It was developed with the objectives of obviously reducing errors, but the need for each additional data point in together with the value and clarity each would bring, and the objectives of balancing a single data point, a tax rate versus a tax rate, or combined with an assessment and a tax levy. So let's be honest, this document, if you have not or you have seen it already, it's not perfect. It's still a work in progress, but we are really trying to develop something that's user-friendly, that will just make it easier to collect the information from tax rate bylaws and reduce errors. This slide here, kind of a brief snippet of the template. It represents the different assessment classes you will see on the template. users have the opportunity to choose between the tax rate or the mill rate when you do your calculation. So this is a common error on the tax rate bylaws. We often see tax rates and mill rates used interchangeably or not when they should be used. So trying to help municipalities, pick one or the other and not get confused with those ones. And this is, so the MGA 297, as we mentioned through Angela's presentation and the earlier case study, establishes the major assessment classes being residential, farmland, non-residential machinery and equipment. This slide here is also from the template here. So on the tax rate bylaw submission template, we attempt to capture some of the main drivers of the tax rate bylaw, and there's some checks and balances. So as you enter the figures, there will be checks and balances, and we will show that coming up as well. So so on this slide, you can see how the requisitions are composed from the tax rate bylaw. The first column here, these are the taxes levied, and these are a result from the data input from columns 2 and 3 here, the assessment and the tax rate. We will compute these numbers. So as I said, this tax rate bylaw template will be a good tool that municipalities can use. And these are another portion of the template we have. I know it seems overwhelming, but it's actually very simple. So don't get discouraged too fast. This slide shows another snippet here. When the approved template is submitted, it is often too late to make changes or amendments. So if changes are made, a copy of the submission along with a review note will be sent to the municipality. 8 categories have been created of reviewer notes, indicating adjustments or corrections have been made based on the approved tax rate bylaw. And to name a few of these categories, they range from missing information, recalculated figures, and interchanging the tax rate and mill rate. As I mentioned, that happens more than people would think. So don't get discouraged. It's actually quite easy to use. And this slide here depicts some examples of errors that will be listed on the tax rate bylaw template when numbers may not balance or miscalculations are detected. So kind of like I assume most of the audience has filled out the financial information return, and we're all pretty familiar with those errors. It would be the same format if something didn't add up or connect properly, you would see errors as a result. And then here are some resources. So Angela, Lucian, Cows, and myself, we are part of the municipal advisory team. If you have very specific questions about the tax rate bylaw template, that is the information services team. And as mentioned, there are great guides online online and through email, or you can more than happy to call us. We'll be able to help you out. And I'm going to pass it back to Angela. And I'm going to stop sharing.
All right, thanks, Jordan. And thanks for all the great questions. We're going to try our best to answer. But I think we're going to commit to doing an FAQ like we did on a previous session of this last year. So we will go through the questions and provide the written answers and then send them out to everybody. That way we can maybe do a little more work on them to get the right answer. Some of these questions have to do with the software kind of things, how they match with what we're saying, but I don't know, maybe folks, I appreciate folks jumping in and providing their perspectives if they can. There was a question. My throat is going again. Oh, excuse me. There was a question about a date, like dates for when the tax bylaw has to be passed and that type of thing. When the budgets have to be passed, the budgets for sure have to be passed by January 1st of the current year. As for the tax rate bylaw, it just says that it has to be passed annually. But if you use a combined assessment and tax notice, you need to get those notices out before July 1st, right? The assessment notices have to be sent out before July 1st. So that would make your tax bylaw have to be passed before that, so you can get both the combined information for the assessments and the taxes on those notices. Otherwise, if you just use if you do them separately, there's no real deadline for getting out the tax notices. They just have to be sent out by the end of the year. So hopefully that answered that question. Jordan, are there any questions that you can pick out that we might have to take these questions about software offline? Is the 2024 municipal tax rate bylaw submission new is a question. I believe there was some changes from last year, correct, Jordan?
Yes, it is new. Yes, it is new. The previous year, they just would have sent in the PDF. For this year, we're actually doing an Excel spreadsheet. So
Right.
yeah, it's brand new.
And if people didn't get a link to
Yep.
to where they submit, they can, who do they
Information
contact?
services team, they can contact MA advisory or the MA updates and get that sent to them.
Oh, this question, Jordan, maybe I think you might be able to answer. What's the best way to accurately figure out the amount of minimum tax that will be applied without going through each property? Like, is there some sort of something you can do with a spreadsheet to kind of
there really isn't. The MJ doesn't specify what a minimum tax should be. You just want to make sure that you don't make it too high so it doesn't become a flat tax, because a flat tax, I believe, is not allowed. Yes,
I think this question is like, when you're adding that amount of your extra revenue in your budget, how do you calculate that easily?
You'd have to estimate what you believe would be if municipalities property tax proceeds are under a certain threshold, then obviously you would use the minimum tax, and you can estimate that pretty easily for how many properties you have in your municipality that would not make that threshold.
So
I was wondering if software out there would have the capability of, you run it with the minimum tax in place and you run it without and see what the difference is, and that kind of gives you an idea as to what the difference would be as a result of running a minimum tax.
Yes, that should be cover up minimum expenses, right? Everything you add up, and then minimum expenses, what is the cover up the minimum expenses for the municipalities to run out. So that should be considered as a minimum tax.
Yeah, more I'm thinking of how do you, in terms of practically how you reflect the amount of revenue you'll get from the additional revenue you'll get from doing a minimum tax. I was more thinking about how you come up with that. So as opposed to how you derive how much the minimum tax should be, which is, yes, of course, you want to figure out what you want to charge, what your philosophy is on charging. Are you charging for the cost of services, etc.?
Amanda Riley, I like your answer. Do you want to say something?
Oh,
You're
I was
welcome
just
to
trying
if you
to,
like.
sure, I can, I was just trying to help out, but you'd have to figure out based on your tax rate, which properties qualify for minimum tax. And then you should be able to pull that, how many properties, whether if you use an assessor, they should pull out they can pull out how many properties fall under that value for assessment value.
The only thing there is it doesn't tell you how much, since you're charging the minimum rate, you're not charging the other amount. And so it doesn't tell you the difference of those two things, because it's not sort of pure gain when you have minimum tax. It's pure gain above what you would have taxed. So there is, you know, like, but it would, you know, that does help for sure.
Yeah.
If I can interject, because I can't find my little hand. Excel does have a nice if-then function. And that's exactly what we've done in our spreadsheet. You just run a line down and it basically, if a property value is this, it applies the minimum tax. If it doesn't meet the criteria, then it's the mill rate times the valuation. I do actually have a sample, that's what we use. And somebody can certainly just send me a little note and I can send that spreadsheet.
Okay, well, thanks so much, Tony. Again, yeah, we'll take a closer look at all these questions and provide written answers for them, and we can do a little bit more explanation for this question as well. But thanks for that. Are there any other questions that we can tackle right at this minute? I haven't been looking through all the questions all the way back, but
This session, they are asking for recording is available. Yeah, I believe this session
Yeah.
is recorded. Yeah.
yeah, we'll post the recording afterwards.
Is it, do you want me to run through the questions right now, or we'll just leave it at that?
Well, yeah, I think we'll leave it here unless someone has something really burning they want to include at this point. But yeah, I just want to thank everyone for joining us today. Thanks for your questions. Thanks for your attention. No, it's not the most exciting material, but it's important stuff. I hope your tax season goes well, and you can watch out for the recording and watch out for the Q&A that we'll send out. And thanks very much, and enjoy the rest of your day.